Crypto arbitrage is a trading strategy that exploits price discrepancies of digital assets across different exchanges or markets. So if you're purchasing a crypto at a lower price and selling it at a higher price on another platform, then as a trader, you are able to secure profits from these market inefficiencies. So the approach leverages decentralized, fragmented nature of crypto markets, where variations in supply and demand, liquidity, or just regional factors can lead to different asset valuations across different platforms. So today we'll be talking about the types of different crypto arbitrage strategies. If you like the kind of content on this channel, make sure you hit the like and subscribe. Also check out the links down below for the best platforms for you to exercise your arbitrage strategies on. Right, so the first one on our list today, we're talking about spatial arbitrage, which is also known as cross-exchange arbitrage. So this strategy involves buying a cryptocurrency on one exchange where the price is lower, and simultaneously selling it on another exchange where the price is much higher. So the key here to success in spatial arbitrage, it's just the rapid execution of the trades to capitalize on those fleeting price discrepancies. For example, one exchange could be having Bitcoin priced at, let's say, 30,000, right? Another exchange could have it priced at 30,500. A trader could buy Bitcoin on exchange A and sell it on exchange B, securing a profit minus transaction fees. So there's also something called triangular arbitrage. So this is an intra-exchange strategy exploiting price differences between three cryptocurrencies within the same exchange. So it involves trading one crypto for a second, the second for a third, and then converting it back to the original, profiting from the relative price differences among the three. So if, for example, you could trade Bitcoin, BTC for Ethereum, then trade Ethereum for Litecoin, and then trade Litecoin back to BTC. If the exchange rates among BTC, ETH, and Litecoin are favorable, the trader can end up with more Bitcoin than they initially held. So this is called triangular arbitrage. Then you also have statistical arbitrage, right? So this is a strategy employing quantitative methods and statistical models to identify trading opportunities that are based on historical price data and correlations between different cryptocurrencies. And traders execute a large number of trades relying on mean reversion principles and market inefficiencies to kind of achieve profits over time. So some of the key components of this mean reversion, which is assuming that the prices of the asset will revert back to their historical average over time. And then you've got the market inefficiencies there, where you're identifying mispricings and exploiting them before the market actually corrects. So some of the tools now that you'd need for your arbitrage trading include just kind of, if you look at the rapid rise of crypto markets, it's leveraging technology essential for trading. You're looking at automated trading bots, right? These bots can monitor multiple exchanges simultaneously and execute trades at high speeds, capitalizing on arbitrage opportunities that exist for milliseconds. Arbitrage scanners, also software that detect price differences across exchanges in real time, alerting traders to potential arbitrage opportunities. The other thing I wanted to really touch on when it comes to just arbitrage is really just the challenges and considerations that you need to have there. So while it can be profitable, it comes with a set of challenges like transaction fees. High fees can actually erode your profits, right? Especially when dealing with the small price discrepancies, withdrawal times and deposits. Delays in transferring funds between exchanges can cause traders to miss arbitrage opportunities. And market volatility also, rapid price changes can turn potential arbitrage opportunities into a loss if not executed promptly. Then you've got regulatory risks, right? So different jurisdictions have varying regulations concerning cryptocurrency trading, which also impacts the feasibility of arbitrage strategy. So at the end of the day, just when you're looking at crypto arbitrage, is representing a compelling opportunity for traders to profit from market inefficiencies and just understanding the various strategies and leveraging appropriate tools. Traders are able to navigate complexities of arbitrage trading. It's also crucial to just remain cognizant of the associated risks, of course. Make sure you go to decentralized.news. That's our main URL. Free resources and tools, all that good stuff. If you want to get started with wagering in the Web3 space, that's wagering on the blockchain, non-custodial betting, sports betting, go check out smart contract bits.xyz. That's the best platform to get started. It's powered by Zero Protocol. Like, share, subscribe, turn on the notifications. I'll see you guys in the next video. Peace. Love.